Financial markets are like the heart of a bustling city. They connect people who have money to invest with businesses and governments that need capital to grow. Imagine a world without these markets. Businesses would struggle to expand, and individuals would have fewer opportunities to grow their wealth. Financial markets serve as platforms for buying and selling a wide range of financial instruments. These instruments represent value and can be traded between investors. Think of them as pieces of a giant puzzle, each playing a crucial role in facilitating the flow of money. These markets play a vital role in economic growth. By channeling funds to their most productive uses, they foster innovation, create jobs, and drive progress. A healthy financial market is a sign of a thriving economy. Understanding how these markets work is essential for anyone looking to participate in the world of investing. Whether you're saving for retirement, a down payment on a house, or your child's education, financial markets provide the tools to reach your financial goals. There are many different types of financial markets, each serving a specific purpose. Let's explore some of the most common ones. Stock markets are where investors buy and sell shares of publicly traded companies. These shares represent ownership in the company, and their value fluctuates based on supply and demand. Bond markets are where investors can lend money to governments and corporations in exchange for interest payments. Bonds are generally considered less risky than stocks, and are a popular choice for conservative investors. Foreign exchange markets facilitate the trading of different currencies. When you travel abroad and exchange your currency, you're participating in the forex market. Commodities markets deal with raw materials like oil, gold, and wheat. Prices in these markets are influenced by factors like supply and demand, weather patterns, and geopolitical events. Derivatives markets are where investors trade contracts whose value is derived from underlying assets like stocks, bonds, or commodities. Derivatives can be complex instruments used for hedging risk or speculation. Cryptocurrency markets are a relatively new addition to the financial landscape. These decentralized markets facilitate the trading of digital currencies like Bitcoin and Ethereum. Navigating the financial markets can feel like entering a bustling city with a cast of diverse characters. It's helpful to understand the roles of some of the key players. Investors are individuals or institutions that put money into financial markets with the goal of earning a return. This could be anything from individuals saving for retirement to large pension funds managing billions of dollars. Brokers act as intermediaries between investors and the markets. They execute buy and sell orders on behalf of their clients, providing access to the exchanges where trading occurs. Traders buy and sell financial instruments with the goal of profiting from short-term price fluctuations. They play a vital role in providing liquidity to the markets. Market makers are specialized traders who provide liquidity by continuously quoting buy and sell prices for specific securities. They ensure there's always a buyer or seller available, facilitating smooth market operations. Regulators like the Securities and Exchange Commission, or SEC, oversee the financial markets to ensure fairness, transparency, and investor protection. They establish rules and regulations to prevent fraud and maintain market integrity. Section 4. Understanding stocks. Stocks are a fundamental building block of many investment portfolios. When you buy a stock, you're buying a piece of ownership in a publicly traded company. Here's a closer look. Common stock represents ownership in a company and gives shareholders voting rights. Stockholders typically receive dividends, which are a portion of the company's profits if and when the company decides to pay them. Preferred stock usually doesn't come with voting rights but offers investors a fixed dividend payment that takes priority over common stock dividends. This can make them more appealing to income-oriented investors. Investing in stocks offers the potential for high returns over the long term, but it's important to remember that stock prices can be volatile. This means their value can go up or down significantly in the short term. When deciding which stocks to buy, investors often consider factors like the company's financial health, growth potential, and industry trends. Diversification, or spreading your investments across different stocks and sectors, is a key strategy for managing risk. Section 5. Exploring bonds and mutual funds. Bonds and mutual funds offer investors alternatives to investing directly in individual stocks. Bonds are essentially loans that you make to governments or corporations. When you buy a bond, you're lending money for a fixed period in exchange for regular interest payments and the return of your principal at maturity. Bonds are often seen as a more conservative investment compared to stocks. They typically offer lower returns but also come with lower volatility. However, it's important to note that bond prices can still fluctuate based on interest rate movements. Mutual funds pool money from multiple investors to invest in a diversified portfolio of assets such as stocks, bonds, or a combination of both. They offer a convenient way for investors to achieve diversification without having to buy and manage individual securities. Mutual funds are managed by professional fund managers who make investment decisions based on the fund's investment objectives. These objectives can range from aggressive growth to income generation or capital preservation. Section 6. Navigating risk and return. In the world of investing, risk and return go hand in hand. Understanding this relationship is crucial for making informed investment decisions. Risk refers to the possibility that your investments could lose value. Different asset classes carry different levels of risk. Generally, stocks are considered riskier than bonds, but they also offer the potential for higher returns. Return refers to the profit you make on your investments. It can come in the form of capital gains, selling an asset for more than you paid for it, or income, like dividends from stocks or interest from bonds. Your personal risk tolerance, or how comfortable you are with the possibility of losing money, should guide your investment decisions. If you're risk-averse, you might prefer a more conservative portfolio weighted towards bonds. If you're comfortable with more volatility, you might allocate a larger portion of your portfolio to stocks. It's important to remember that diversification is key to managing risk. By spreading your investments across different asset classes, you can reduce the impact of any single investment on your overall portfolio. Section 7. Getting started tips for beginners. Embarking on your investment journey can feel daunting, but it doesn't have to be. Here are some basic tips for beginners. First, define your financial goals. What are you saving for? Knowing your goals will help you determine how much to invest, your time horizon, and your risk tolerance. Second, start early and be patient. The power of compounding, or earning returns on your returns, is most effective over long periods. The earlier you start investing, the more time your money has to grow. Third, do your research and choose the right platform. There are numerous online brokerage platforms available, each with its own fee structure and features. Take the time to compare and choose one that aligns with your needs and budget. Fourth, consider low-cost index funds or ETFs. These funds track a specific market index, providing broad market exposure at a low cost. They're a great option for beginners looking to build a diversified portfolio. Finally, invest consistently and stay disciplined. Avoid trying to time the market or making impulsive decisions based on short-term fluctuations. Instead, focus on making regular contributions to your investments and stay the course. Remember, investing is a marathon, not a sprint. By starting small, staying informed, and remaining patient, you can harness the power of financial markets to achieve your financial aspirations.